Let me explain the concept behind the breakout system. So remember that prices move in cycles, right? They go on uptrends, they go on downtrends, and oftentimes they go into periods of consolidation where the price moves sideways within a range. Now it can't stay in a range forever. So if I can illustrate, if you look at a stock, for example, and the stock's on an uptrend, now remember how we define an uptrend. An uptrend is defined by higher highs and higher lows, right? So the price makes higher highs and higher lows. And when this happens, basically the market is bullish, right? Buyers are stronger than sellers, so the price keeps trending higher, okay? But again, it can't go on an uptrend indefinitely. Eventually, it's like a runner. After the runner runs for a while, he has to rest. So after a strong uptrend, oftentimes what happens is the price will then start to go in a sideways fashion this way, where it doesn't make higher highs anymore. It makes same highs. So this was a high. This could be $10, for example, and then it makes the same high at $10. Same high, same high. So it can't go beyond a certain level. And this level, as we've learned in the previous lessons, is known as a resistance level, a level of resistance where the price can't seem to break above. At the same time, it also will not go back down very much. So it's kind of like there is a level of support over here. So this is what we call a consolidation, the price going sideways. Now, what happens after consolidation period? There are two things that can happen. Well, the first thing that can happen is eventually the price would eventually break above that resistance. So eventually there'll be enough buyers that will be able to overcome all the sellers at this level. And when it breaks this level, it's usually the beginning of a new uptrend. And this is the point where many traders, they would like to get into that stock to catch the new trend, to catch the new bullish momentum after it's been resting for a while. Okay? I like to use the metaphor of a person who was in a prison, for a couple of months or years, and eventually he breaks out of the prison, right? He starts running, right? And you want to get him while he's starting to run away, okay? Now, or the price can eventually break below the support level. In other words, there are more sellers than buyers, so much so that the sellers overcome the buyers at this level. And it breaks that level of support, and it's the beginning of a new downtrend. And that's when, again, many traders, they like to get in to start to sell short the stock and catch that new downtrend down. Now, after consolidation, you never know whether it's going to break into an uptrend or it's going to break into a downtrend. You can't predict the future. No one knows what's going to happen until it happens. So in this strategy, we are waiting to see, does it break out of the consolidation or break down from the consolidation? If it breaks out, we want to buy and go long and catch the new bullish trend. If it breaks down, we're going to go short and catch the new bearish trend. So you understand the concept? All right. So let me read to you the formal definition. All right. So the breakout is a swing trading strategy that seeks to buy stocks that have broken above the resistance level from a consolidation. Because when a stock is able to break above a strong resistance from a consolidation, there's a high probability that bullish momentum will trigger the start of a new uptrend. And oftentimes, the longer the consolidation, the stronger the breakout. It's like the longer the guy's been in jail, the faster he'll run the moment he gets out of jail, right? Or the longer the constipation, the stronger the breakout. Put a crude example, right? So over here you can see this stock was in a consolidation, and this was again a resistance level at this level, right? So the price goes up and then comes down, goes up, comes down, goes up and comes down. So there's a very strong level of resistance at, for example, 136.75. So again, recall from previous lessons, what creates that resistance? What creates a resistance means at 136.75, there's more supply than demand. That means many sellers are waiting there to sell. So the moment it gets to 136.75, sellers will rush in, they'll sell, 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 and push the price down. So it tells you that there are many, many sellers that are over here waiting to sell. Okay. At the same time, when the price goes down to, in this case, 125, what happens? Price goes down and suddenly it reverses back up again. It goes there, it reverses back up again. It goes down, it reverses back up again. Now again, notice I've mentioned in previous lessons, support and resistance are not like brick walls. It doesn't go exactly there and bounce off. Sometimes can go below for some buffer and then come back up again. Similarly, in a resistance, it could go above the resistance and come back down again. It kind of like fakes you, right? So it's kind of like a fence and not a brick wall. So a brick wall's something like the price goes, boom, it goes down, boom, it goes down. It's not like that. It's like a fence where the price can go and hit the fence can bend a bit and go back out again. All right, so oftentimes people call these false breakouts, where it looks like it's breaking out, and that's when some amateurs will buy and then they get faked out. Okay, so I'm going to teach you how to avoid many of these false breakouts, where it looks like the prisoner is escaping, but he's not really escaping. He got caught back into that prison. So there are ways that we avoid these false breakouts. So we want to get in only on the breakout that has a high probability of succeeding, where we know that the prisoner's out of jail, you know, the cops are far behind, you can't catch him, and he's running, and that's when you get in and you buy the stock and you catch the breakout with that. And again, a breakout happens when usually there's some kind of news, and we don't care what the news is, we don't care why it happened, we just look at the price action that tells us that suddenly there are more buyers than sellers, and there were enough buyers to buy up all these sellers, and this triggered, again, optimism, bullishness in the stock that says, hey guys, this stock's running, and everyone runs in, they get on the train, and it runs. Okay, so that's when we want to get in. This is a breakout from a consolidation. Now, on the other side of it, on the short side, we aim to sell short stops that have broken below the support level of a consolidation. So remember I said in a consolidation, it can also break down eventually. When a stock is able to break below the support level of a consolidation, like in this case the support, it's a strong support, and it broke the support, it broke. So it means that suddenly there were so many sellers that all the buyers over here had their orders filled. There are no more buyers left, but there's still many, many sellers, and no one wants to buy anymore, right? And that triggers the price to just collapse all the way down. So once it breaks below a strong support, there's a high probability that bearish momentum will trigger the start of a new downtrend. And that's, again, when we want to get in to short the stock and profit as the price goes down. Now, the first thing we need to do is we need to define what is a valid consolidation pattern, right? Because one of the common mistakes people make is they think it's a consolidation. It is not a consolidation. They think it's a resistance. It is not a resistance, right? Sometimes in the market we see what we want to see, but it's not really there, right? Sometimes the market can play tricks on you. So I have to correctly define what's a consolidation, and you have to follow the definition strictly. And it cannot be subjective, it's going to be really objective. Okay, so when trading breakouts from a consolidation pattern, I'm looking for consolidation with a flat top resistance that's tested at least 3 times. Okay, so I like to trade consolidations when there's a flat top resistance. So the resistance is a straight line, it's a horizontal line that must be tested 3 times. And as the price goes up, hits it, comes down, that's 1, goes down, hits it again, 2, hits it again, 3. So it's going to be tested 3 times to tell me it's a strong resistance. Okay, so here's an example. Price goes up, hits a certain level. So this could be, for example, $10. Boom, comes down. And goes up again and goes to that same level. Boom, comes down again. And then goes up to that same level again, $10, and comes down again. So this was tested 3 times. In fact, it goes up again and boom, comes up. Tested 4 times. So only then do I know that this is a strong resistance. And only when it is broken would I consider a breakout. So over here you can see it goes up, boom, tested 5 times. The more times it is tested, the stronger the consolidation is and the stronger the breakout will be eventually. And over here, what happens? Boom, it breaks out. And that's when we buy. And we catch the trend as it goes up. Okay? So this is one possible scenario. The second scenario, okay, so let me just say that for the first scenario, what we're looking at is same highs and same lows. So the price makes same highs. Let me just get rid of this drawing again. Same highs, same highs, same highs, and same lows, same lows, same lows. Okay, so that's the first scenario. The second scenario is same highs, which is the same thing. That's 1, 2, 3, 4, 5. Tested many times, right? So same highs, same highs, same highs, but in this case, it is higher lows. You can see this low, it's a low, it's a low, it's a low. So it's like that, and it's right. The first one was like that, and it's like right. So either one's fine, but for both scenarios, we want same highs. Now, I've mentioned this in previous lessons, I think in the basic course, on how do you draw these resistance and support levels. Okay, and let me just mention it very quickly again here. Now, like I mentioned earlier, the price doesn't always go up and come down and go up and come down exactly at this point always. Right? This doesn't always happen in the real world. In the real world, the price can go up, come down, and go up higher, come down, and do something like this, and like that, right? It could be like that. So where would you draw the resistance? That's a very common question I get asked. So would you draw the resistance at point A, line A, or would you draw it at line B? Which one? My personal preference is to draw it at line B, not line A. Why? Because line B is more significant because it was touched more times. You can see line B was touched once, twice, 3 times a lady, no, just kidding, and 4 times. Okay, so to me, B is a stronger resistance. A was touched only twice. So in other words, when I draw these support and resistance levels, I draw it at the line of best fit, where it touches as many points as possible. It doesn't matter to me, does it touch the shadow of the candle or the body of the candle? That's not important. What's important is it touches as many points as possible. So why do I draw it here? Because you can see it touches once, twice, 3 times, 4 times, 5 times. That's a significant level. That make sense? Okay, so do understand that. Now, on the short side, when we are trading breakdowns, okay, so when trading breakdowns from a consolidation pattern, I'm looking for a consolidation with a flat top support. So in this case, I want the support to be horizontal, that is making same lows and is tested again at least 3 times. So let's take a look at this. So this is the first scenario where it makes same lows and same highs. So price goes down. So again, this could be $10, for example. And then boom, goes up. Right? And comes down, goes up. Comes down, goes up. So that's 1, 2, 3. And again, it's tested 3 times. And notice I'm drawing again the line of best fit, where it touches as many points as possible. And again, notice it makes same highs, and same highs. Okay? So if I'm going short, I want the support to be tested at least 3 times. And eventually here it breaks the support, it breaks it, and boom, triggers a downtrend. The second scenario would be similarly same lows as previously, same low, same low, same low, same low, but lower highs. Right? So this high and this high is making lower highs. It's kind of what we call a wedge pattern. All right. So again, the first one. So the first one is Same lows, same highs. Boom, 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 breaks. Second one is same lows, lower highs, like a witch. It goes like that, and boom, breaks down. Okay, so either one's fine. All right, so how do we set up the charts for this strategy? For the breakout system, I use these combination of indicators. So I'm using the 20 and 40 exponential moving average, which measures the short-term trend. And I use the 50, 150, and 200 simple moving average to measure the medium-term trend. I use three indicators: the force index with a default setting of 13, the moving average convergence divergence (MACD) with 12, 26, and 9 setting. It's a default setting, and the parabolic stop and reverse. And basically, these three indicators are momentum indicators. They help me to identify if there's bullish or bearish momentum in the stock. So let's take a quick look at how I set up the charts right now. All right, so I'm going to show you how I set up the charts on Thinkorswim. This is the TD Ameritrade Thinkorswim platform. And again, you can use any kind of charting software. You can use TradingView, you can use TC2000. It doesn't matter because all the charting software will have the same kind of indicators, right? So it doesn't matter. So I'm just going to use Thinkorswim for this demonstration. And the first thing I'm going to do is I'm going to put in the moving averages. So I'm going to go to this, which is the magic potion, which is basically to insert your studies and strategies, your indicators. And I'm going to select moving averages, exponential moving average. So I'm going to choose 2, 1, 2. Okay, there are two exponential moving averages. One is a 20, one is the 40. So I'm going to change this to 20 moving average. Click on this. Change to 20. So again, depending on your charting software, you just have to change it to the required moving average. So I'm using 20 EMA, and for that I usually use red. And I'll change that to the 40 moving average. Oops, sorry. I forgot to change the color. Should be blue. Okay, there we go. So 20, 40 EMA. Next, I'll put in the simple moving averages. So remember the 20, 40 exponential moving average and the 50, 150, 200 simple moving average. So simple moving average over here. Simple moving average. Click 1, click 2, click 3. All right, so we got it 1, 2, 3. So first one, I'm going to change to 50. And blue. And I'm going to change it to a thick line, like a width 2. So I don't get confused with the 40, which is the thin blue line. All right, and then next is the 150 moving average. Green, thick line. And finally, the 200 moving average, which is the red thick line. Okay, so I put in all my moving averages, 20, 40, 50, 150, 200. Okay, next I'm going to put in my three indicators. The first is the force index. There we go, force index. Click, click. And by default it's 13, so we'll leave it as 13. Next is the parabolic SAR. That one, click, click. And yeah, that is parabolic SAR. And I want to change the color to black. Just my preference. Okay. Finally, I'm going to use the MACD, moving average convergence divergence, MACD. And by default, it's 12, 26, and 9. So just leave it. But maybe in your charting software, it is not 12, 26, and 9. You just have to change it to 12, 26, and 9. Okay, I'm going to change it to black. And red for the signal line. Okay, black for the MACD line, red for the signal line. Okay, so I put everything in and I'm done. So I'm going to click, I'm going to save it. So click save. and save it as breakout. Okay, so notice that for different strategies, I use different indicators, right? So like for the bounce, I'm using the 18, 50, 100 exponential moving average. And for the breakout, I'm using the 20, 40 exponential and the 50, 150 simple moving average. And for the bounce, I'm using stochastics. Whereas for breakout, I use force index. So it's like you cook a different dish, you use different ingredients, all right? And over the years, these ingredients have worked for me. So I'm just sharing them with you. Why I use certain ingredients. It's because of years of experience, of testing, that I found that these work for me. Okay, so I'm going to click save. Now, I've already got it saved, so I'm just going to leave it. Just click save, and you have it there, all right? And you have all your indicators over here. Let me show you a stock which I recently bought on a breakout. It's POOL, pool. Okay, so this was a trade which I recently called out in the trade alerts, and I got into this trade. And this was a breakout pattern on POOL, pool. Okay, so a few things I'd like to show you would be, again, how do you read these indicators? Well, let's go step by step. Well, the first one is the force index. And this is an indicator invented by Dr. Alexander Elder, and it measures volume, right? The strength of the volume in the price change. So basically, you see this red line, which is the zero line, okay? And this purple line goes up and down. That's the force index. So when the force index is above the zero line, that tells you that the force is positive, or is bullish, right? It's bullish. Market, the price is bullish. And if the price goes below the zero line, it is bearish. Okay? So whenever I buy, I want to go long, I would ideally like to check that the force index is above zero and it's rising. Okay? That means the force is positive. If I'm going to go short, then I want the force index to be below zero and falling. Right? So that's how you read the force index. Now, MACD is moving average convergence divergence. Don't worry too much about the mathematics and the name, it's how you use it, right? So basically, you see this black line and this red line. Okay, so this black line is the MACD line. And the red line is called the signal line. Now, when the black line is above the red line, notice you see these green bars, right? So whenever the black line is above the green line, you will see these green bars. And it means that the momentum is bullish, right? It's bullish. Now, when the black line crosses below the red line, MACD line crosses below the signal line, you see these red bars? That means momentum is bearish, okay? So similarly, if I want to go long, I want to buy, ideally, I want to see MACD bullish. If I'm selling short, I want MACD to be bearish. Okay, so that's how you read the MACD. The next one is the parabolic SAR. The parabolic SAR are these dots. Can you see these dots? Okay, so when a dot is below the candle, that means the momentum is bullish. When a dot is above the candle, it is bearish. So again, if I want to go long, I want to see that the dots are below the candle. If I want to go short, I want to ensure the dots are above the candle. Okay, so some people would ask me, so Adam, are you saying that if I want to go long, I want to buy, all three indicators must be bullish? That means the parabolic SAR must be below the candle, dot below the candle, the force index must be above zero, and the MACD must be bullish. That means the MACD line, black line above red line, green bars. Must all three of them have to be bullish? The answer is no. You don't need all three of them to be bullish, because sometimes by the time all three of them are bullish, right, the price has already gone up too high and it's a bit late to get in sometimes. So out of these three indicators, we just want to see one out of three of them to be bullish before we buy on a breakout. Okay? Similarly, if I'm going to go short, if I'm short selling, the breakdown of the consolidation ensure that 1 out of 3 of the indicators are bearish. Okay, so we don't need all 3, we just need 1 of the 3 to show bullishness if we're going long and bearishness if we're going short. All right, so hope that clears that up. Okay, great. Now let me also orientate you to the moving averages. So yeah, let me first of all remove the lines. Okay, so this red line and this blue line, this is the 20 and 40 exponential moving average. The 20 and the 40, right? Basically, when the 20 is above the 40, the short-term trend is up. Okay, so you can see right now the short-term trend is up. And when we go long, we want the short-term trend to be up, the 20 to be above the 40. Okay? Then this big blue line is the 50 moving average. Let me can draw it for you. So this red line is the 20, this is the 40. Okay? So when the 20 is above the 40, it's a short-term uptrend. Okay? Now this thick blue line is the 50 moving average, the green line is the 150, and the red line is the 200. Okay? So when the 50 moving average is above the 150 and it's above the 200, when you've got 51, 52 in this sequence, it means the medium-term trend is up as well. Okay? So when I'm going long, when I'm buying, I want to ensure the short-term trend is up and the medium-term trend is up. So 20 should be above 40, 50 above 150, and above 200. So all the stars should be aligned. Okay? Now if I'm going short, breakdown, then it's the opposite scenario, right? So the 20 is below the 40, 50 below the 150, and so on and so forth, right? So can you see why I entered this trade? Well, first of all, let me remove all the studies so you can see the candles a bit clearer. Okay? So if I go to my drawing tools, you can see over here there was a dum dum. Sounds like Law and Order. Dum dum. Okay, there you go. And then you have, okay. So you can see, I see me drawing this resistance over here. And again, why do I draw it here? Because it's the line of best fit. It touches as many points as possible, right? So to me, this is a strong resistance. And it tests 1, 2, 3, 4. It tests 4 times. So it is a strong resistance. Okay, and here is 1, 2, 3. Test 1, test 2, test 3. So it's making same highs as we mentioned earlier and same lows. So this is clearly a consolidation pattern. So I was waiting for a breakout. Okay, so where did it break out? It broke out here, right? So that was the breakout. It broke out of the consolidation. And later I'm going to teach you how to identify a valid breakout. So just hold on for a while. So just understand that that's a breakout. And again, at this breakout, I want to ensure that the moving averages are in sequence, right? So the 20 is above the 40, the 50 above the 150, and one of the indicators is bullish. So let me show you again the indicators, which we put in earlier on. Here we go. So can you see that at this point, when it broke out here, this is a breakout, right? Again, notice that the 20 is above the 40. Short-term uptrend, 50 above the 150, medium-term uptrend above the 200. So all the moving averages indicated that the trend was up. All right, the parabolic SAR, the dots are below the candle, that's bullish. The force index is above 0, that's bullish. And the MACD is also bullish. So in fact, we had 3 out of 3 indicators bullish, which we don't need. We just need 1 out of 3. But in this case, we had 3 out of 3. So this was a really good trade. And that's why I entered here to catch the trend up. All right, so that's how you set up the charts for breakout patterns.